Hi, this is Alessio, hope you're well. In this video, I'm going to talk to you about a particular strategy, a very important strategy, which we can apply when there's a significant decline in the price, when there's a significant crash or drop in the price, what we call often a waterfall crash or a waterfall decline, as you can see here. So the question I want to try and answer in this video, what are the particular strategies that a trader may apply in a situation like this when price is falling, for an entry into a long position? In other words, for an entry into a bullish position, or indeed when the odds can turn in your favor in the bullish direction. How can we find that out? What do we need to look at? Join me. Alright guys, welcome back. By the way, I'm making this video in Dartmoor National Park, which is absolutely a beautiful and amazing park. Really peaceful. I highly suggest if you have a chance, come over here and visit. Okay, let's talk about the strategy. So let's imagine a situation when price is crashing really hard. Let's say you have a significant drop in the price. Could be anything, could be stock markets, could be Bitcoin, could be gold, currencies. And what I'm referring to specifically is on a daily chart of that market. So I'm not so much concerned about the lower time frames, but I'm specifically referring now to the daily time frame charts, but not the lower time frames, because lower time frames have greater risk. So let's imagine a situation like this. For example, you may remember the stock market crash of March 2020. I'm sure everyone remembers that. That was at the beginning of the pandemic when everybody was panicking and essentially selling really hard. As you can see here, the stock markets, the S&P dropped that month by about 34%. In fact, that drop in the stock market was the most intense and the fastest stock market crash in history. In fact, arguably, it was the quickest bear market in history as well. But here's the point. You can see it's a very strong decline in the price, essentially a waterfall decline or a waterfall crash, or essentially the price was not stopping at all. It was just dropping. But here's the question you might ask. What would the price have to do at a minimum to increase the odds that it potentially could reverse and go back up? As you can see here, it did eventually reverse and went back up. But what is the minimum thing that a trader could look at or a chartist could look at to increase the odds in their favor that price is about to potentially reverse and move in the opposite direction? Now, of course, there's a number of things one could look at, but I want to show you one of my favorite methodologies or strategies. And it's really simple. So as the price, notice, was crashing here, was dropping here on the S&P, we're going to put on our chart an 8 EMA, an 8 exponential moving average. By the way, if you're new to chart analysis, putting a moving average on a chart is really simple. Essentially what you do is you choose exponential moving average on the chart there, and then you just change it to the 8 setting, the 8 period setting of exponential moving average. And that's the red line you see there on my chart. All we have to do now is wait for the price to, as it's dropping here, just wait until it closes back above the 8 EMA. Notice what happens here. As the price continues to drop and decline, eventually the price did go back above a bit and closed above the 8 EMA. Okay, you can see it closed back above the red line. And when that happens, when price closes back above the 8 EMA, the 8 exponential moving average, now there's a slightly higher probability of a potential reversal in the price, or at least a potential correction, some kind of retracement or a pullback, or a potential temporary bounce or rally. So all we're saying is, let's be patient and wait for the price to just bounce back a little bit and then close. When I say close, I mean I'm talking about the price bar, the candle bar. Wait for it to close on the daily chart, not the lower time frames, but only the daily chart. Wait for it to close back above the 8 EMA. And you can see it did that right there on that bar. And notice what happens next. Now the odds have slightly improved in our direction, in the upward direction. So when the price manages to close back above the 8 EMA, there's a slightly higher probability, there's a slightly higher edge to price going up than going down. And notice, by the way, the price did actually bounce quite nicely higher, as we can see on this chart. By the way, guys, check out these guys in their little boats here. I think they're canoeing or something here. All right, guys, so as a charting strategy or as a trading strategy, what a trader may do in this situation is, a trader may, for example, enter with a small position when the price closes back above the 8 EMA, put a stop loss right at the very lowest point where the price dropped at. So a trader could put a stop loss 1 point below that level and essentially wait for the price to bounce back up or hit the stop loss. But again, notice what we're doing is we're limiting the risk as well. Because listen, what the temptation may be in this situation is when price is dropping heavily, when price is crashing, there may be a temptation for someone to say, oh, here's a bottom. Oh no, here's another bottom. Here's a bottom. No, this is the bottom. So there's a lot of guessing going on here as to where the bottom is, where the floor is. Instead, forget all that, forget the guesswork. Just wait for the price to stabilize and then go back and close back above the 8 EMA. Now you might say, well, that's not exactly the bottom. That's true. But again, remember, we're not looking for the exact bottom. All we want is for the odds to improve in our favor. We want the probabilities to move in our favor before we even consider taking a bullish stance or a bullish position on the chart there, on that specific market. All right, guys? So you might agree with me, this is actually better than guesswork. because anybody can just guess and say, oh, here's a bottom and all that. Forget all that nonsense. Instead, just wait for the price to stabilize and just go back and close back above the ATMA. And that actually improves the probability in our favor. The price could go back up or bounce a little bit. Of course, there's no guarantee or certainty the price could go back up. But essentially what we're doing is we're just increasing the probability in our favor. And again, of course, a trader would limit the risk by putting a stop loss underneath as well. So to make sure in case the price moves back down again, we're protected as well. Let me give you another example. So here's an example for you on this chart. Notice again, price was dropping really hard here. And again, notice price comes down here and then closes back above the ATMA here. Again, what we need to wait for, first of all, is a strong decline. So it's not just any decline of the price, not just any price drop that matters. What we're looking for specifically is a situation where price is oversold, extremely oversold, when the sentiment among the majority of the public out there is extremely pessimistic. So when there's extreme pessimism and extreme oversold conditions, and ideally with some divergences, for example, divergences on the lower time frame, for example, then on the daily chart, we can wait for the price to go back above the ATMA and close above it first. That'll give us a higher probability for a bounce, or a potential bounce indeed. And again, a trader could limit the risk, could control the risk by putting a stop loss right underneath where the low is, and then wait for the price to either move back up or indeed hit the stop loss. And again, let's remember this. There is no guarantee or certainty the price is going to go back up or bounce just because it's closed above the ATMA. That's why we have a stop loss in place to limit the risk and control the risk. And one more important thing I should mention here, position sizing is really important here. What a trader might do to limit the risk here is not to take on a very big position here. That's a very dangerous and risky thing to do. So what a trader may do is to limit the risk is position size with very small amounts. This is often called nibbling on the price with small, tiny positions. Why? Because again, the risk is still high. We're going against the trend here. The trend is still down. So we want to take on very small positions here in case the price goes back down again. So again, nibbling only with small, tiny positions, but not big positions because they're very high risk. I'll give you one more example. As you can see here on the chart, as you can see, price was dropping and then it closed above the ATMA here on the chart and actually improved performance in our direction. And by the way, here's an example for you where this did not work. In fact, price went down and hit the stop loss. So again, we have to remember, not every single time it's going to work this way. That's why we use a stop loss to limit and control the risk. The key point behind this strategy is, again, remove guesswork. Not willy-nilly guessing as to where the bottom is. 2, reduce risk. Wait for the price to stabilize and actually potentially increase the odds. That's the third thing, to increase probabilities in our favor. And then actually we can have a better probability as to when the price could actually go back up again or actually has a bounce. And by the way, one important thing, when the price does bounce up, does actually go in our favor in the same direction we want, we have to also move the stop loss up to the break-even point to limit and control that risk. All right, guys, hope this video helps. If it does, please give it a like and please subscribe for future videos. Thanks so much indeed. Bye for now.